Well, good morning, traders and investors. Today is Monday. It is January 25th. It is the last week of January. 2021 just started, and January is almost behind us. I believe, don't quote me, but I believe this is the first week in January that we don't have a holiday or a day off, or there's some kind of a fragmentation. I think every week so far we've had one day off, or we've had the holidays. So the market's really getting down to it. We've got earnings. Earnings are the big story this week. Let me go through the global news. Let me go through the earnings that are on deck. Let me tell you the big reports to watch out for. And then I'll show you the hottest stocks in each major index. How about that? Good way to start the week. So as far as the market right now, and remember, take it with a grain of salt. Earnings right now are driving the market more so than anything. We're still waiting for the stimulus, but earnings are what's driving the market. As you can see here, the Nasdaq 100 is up 115 points, which is substantial. The Dow's down 167 points, and the S&P is flat. So, and the Russell's also down, and the mid cap are also down. So the only thing that's up is Nasdaq, which leads me to believe, and we'll get into it a little deeper when we talk about earnings, but that's probably because a large cap stock had an earnings report, and it's overcapping the rest of the index. Remember, the Nasdaq 100 only has 100 stocks, and the FANG stocks tend to control about 90% of the index. So it's 100 stocks to begin with, and then you have less than 10 stocks controlling about 80-90% of the entire index. So something to keep in mind. Now, in terms of the week, so again, we've got a lot of earnings this week. We've got a lot a lot of earnings, and we're moving away from bank earnings, and we're moving into broader earnings, which means it'll have a bigger impact on the market like you're seeing right now. I wouldn't make too much of these huge swings because they are earnings driven. And as the market gets going during the day, you'll probably more than likely see this volatility lessen. So don't make too much out of this because this is driven by earnings news. Now, as far as the week, as I said, this is the first week of the year. From my recollection, I think it's the first week in 3 weeks because we had the presidential holiday, and then the second week people were just coming in. So this is the first real full week without a day off or without a holiday or anything like that. And that means volume and volatility should pick up. And as you could see, volatility is already picking up. And that's aside from the fact that it's earnings season. So now, FOMC begins this Tuesday. Expect a subdued market, not because there's a fragmented week, but because we have FOMC, which is a determination of the central bank and the Fed deciding whether they're going to raise or lower rates and give us a prognosis of what they believe. Now, this Fed has been extremely transparent. A little too transparent, if you want me to be honest with you. This is not the Fed I'd like to play poker with. They'll tell you what they're predicting a year in advance. When Yellen was the Fed, she kept tight-lipped, but this Fed likes to tell you everything in advance, so it leaves very little to the imagination, if you will. But expect a subdued market as the FOMC begins till we get the announcement. Why? Large banks, large institutions, large hedge funds, they don't want to make big bets ahead of the FOMC. Then, after FOMC, we got GDP on Thursday. And folks, I'm not expecting a great, big, wonderful GDP. Why? Because jobless claims was at 900,000 last week. We're expecting 875,000 this week. The range is still where it was. And remember, this isn't like lagging every month. This is for the week ending 23rd, last Friday. This is every week, new jobless claims going back a week earlier. So it's very accurate, it's very timely, and it's telling us a lot of people are applying for unemployment. And that's very, very dangerous in light of what we're seeing right now. And I think that's going to reflect negatively on the GDP. Now, most of that is priced in, but if the number is a little worse than expected, if the jobless claims does not come out right, if the personal income report, which follows the jobless claims, isn't pretty, we could be in a pinch. All right, we could be in a pinch. So just be careful. We've got a lot of issues this week. We've got earnings, we've got FOMC, and we've got GDP. So the underlying word of the day is volatility. Now, global markets, Attention turns to earnings. Everything is focused on earnings, and hopes are high that Washington will deliver another dose of stimulus for the economy now that White House and both houses of Congress are under single control. And I think they will. It's just a matter of time. But you know what they're predicting? That 70% of that money is going to go back into the stock market one way or another. Remember summer? Remember Robin Hood? Oy, oy, oy. President Joe Biden proposed $1.9 trillion to send $1,400 to most Americans and deliver other support for the economy. His party holds only the slimmest possible majority in the Senate, raising doubts about how much can be approved. Several Republicans have already voiced opposition to the plan. And COVID pandemic, what news would be complete without me talking about the COVID pandemic? It's only worsening. And folks, I'm telling you right now, even that stimulus may not be enough if this pandemic gets back into the foothold of this country and the world like it's doing right now with China. We're going to see again what we saw in February, March, and April of 2020, and I'm really hoping that we won't. China, where pandemic began in late 2019, the government has reimposed travel controls after outbreaks in Beijing. Beijing, this is a big city. This is a financial capital of China here. Massive support from central banks is providing major underpinning for the market. Oh yeah. The Federal Reserve and others, central banks, are holding short-term rates at record lows and other measures to support economies until the pandemic can be brought under control. Folks, if it wasn't for that, this market would be hurting. And I mean hurting right now. And again, don't think that this stimulus is the answer to everything and the market won't crash. The market, if it does crash, it'll be something like what we saw in March, April of last year. It'll be a quick one. It won't be like one of those prolonged 3-year crashes. It'll be a mini correction because there's just too much money moving into the market to have a major bear market. Interest rates are low and there's money moving. My suggestion is keep your eye on consumer confidence. That comes out tomorrow. Keep your eye on the Fed announcement and durable goods orders, GDP obviously, and jobless claims. New home sales, not really worried about that. Existing home sales were at a 14-year high. Personal income is going to be already reflected in the jobless claims. Consumer sentiment is going to be reflected in the GDP. So again, the biggest reports for the week is going to be consumer confidence, FOMC, durable goods, GDP, jobless claims. Those between Tuesday and Thursday, we're going to get a lot of data and expect the market to be subdued until after the FOMC. Now, in terms of earnings, we've got a lot of earnings this week. Instead of doing it by the date, I did it by volume. So you've got Apple on the 27th. Today's the 25th. So Wednesday, you've got Apple. You got AMD tomorrow. You got GE tomorrow. You've got American Airlines later this week. You got AT&T, Microsoft, Carnival. Carnival is, I don't know about Carnival. Facebook, Tesla, FCX. FCX is one of the hottest stocks right now. Verizon, United Steels. So this week, earnings are going away from bank stocks and are going broad-based. But you could see here, these are, look at this, Boeing, Chevron, Murphy Oil, Johnson & Johnson. So we're going to have a lot of volatility this week. This is going to be the earnings week. Last week, the first 10, 12% of the S&P 500 came out. This week, we're going to have another 20% of it come out. This is going to be a big week with a large number of large cap stocks reporting. To give you an idea of where we stand right now with each index, the S&P, the broad market right now, this is the NASDAQ 100. Semiconductors, lots of semiconductors, Qualcomm, Micron, Applied Materials, and some foreign stocks like Baidu, Merkle Libre. So I'm looking for tech stocks that have global exposure and chip stocks. Nothing really changed there. S&P 500, you've got retail. Nordstrom's, Coach, Kohl's, L Brands. That's what's leading. And basic materials like Albemarle, and FCX are behind it. Those are basic materials. But retail and basic materials for the S&P 500, for the NASDAQ 100, as I mentioned, you want to be in semiconductors and a handful of stocks that are disruptive, like Align Technology, like Tesla, like Baidu, like Moderna. These are the top stocks. Moderna's not really looking all that great long term. But again, I would really focus on the semiconductors. Nasdaq 100 semiconductors, S&P 500 retail stocks, as you could see right here, the retail stocks, and the Nasdaq 100 and the Russell 2000. It's a little trickier. You've got a little bit of everything. You've got GameStop, Transcentrix, Whiting Petroleum. You got a little bit of everything. So overall, you've got isolated stocks in the Russell 2000 breaking out. You've got retail in the S&P 500, and you've got semiconductors in the Nasdaq 100. And again, keep your eye on earnings. We've got a lot of earnings from a wide variety of industries. And by the end of this week, we're going to get a really good idea of where we stand in terms of the economy, because we've got FOMC and GDP and jobless claims and a bunch of other reports. So we're going to be setting ourselves up for a really, really good idea of where we stand and where we're going to go forward. Keep your eye on the major indices, especially with all these volatile moves. Keep your position size low, because volatility is going to be 2-3 times higher than usual, because you've got major reports and you've got major earnings in almost every sector. So that's called volatility driver. So lower your exposure, go to cash partly and ETFs. This is not a time to be a hero. And folks, I've got something important for you. There's a little known calendar, yes, a calendar, much like the earnings calendar and the economy calendar, but it tips us off to stocks that go up on the same day every single year. And it has for decades. By using it, you could have earned $111,000 on one stock, starting with $1,000. Think about this. You start with $1,000 and you make $111,000. That's the definition of a 100 bagger, right? That's just how reliable this secret trading calendar is. It tips you off to stocks that go up on the same day every year for a decade. Right now, legendary fund manager Tom Busby and myself have 10 of these primetime stocks on our radar. And Tom, he wants to give them to you for free. He wants to give you the stock, the ticker symbol, all the accoutrements for free. All you got to do is follow the link below and see how you can get them. It's simple. You're going to learn a lot. It's a lot of value. Make sure you bring a paper and a pen and a piece of paper. You're going to have to write down the dates on these stocks. Follow the link below. Check this out. And stay safe with earnings and this FOMC data and GDP. You got to stay safe. I'll talk to you guys tomorrow. Post some feedback for me. Bye and have a great day.